All right, welcome back to the Know Your Numbers REI podcast, where we talk about the latest tax news, insights, ways that you, the entrepreneur, the real estate investor, the business owner, can make more of your money work for you rather than the U.S. government. My name is Chris McCormack. I'm a CPA. I'm a certified tax planner with the American Institute of Certified Tax Planners down in San Diego, California. I also have an MBA and I am the CEO here at Better Books. We have been working with business owners and real estate investors and entrepreneurs of all shapes and sizes for the past 4 years, helping them plan ahead and proactively work with the tax code so that they're no longer frustrated or stressed out or just left without much cash in their bank accounts as a result of the United States federal and state income taxes, as well as all the other taxes, payroll taxes, estate taxes, capital gains taxes that come along with that. We're going to be talking about some of those taxes today. If you are up to date on current events, you know that there's some talk around taxes because what is now referred to as the one big beautiful bill has made its way through the House and is currently in the discussion around the Senate of whether it will become a law. And included in that big beautiful bill is a lot of insights around taxes. And so for the next 4 weeks or so, we're going to be unpacking it. We're going to be talking about some of the provisions that are being recommended. If at any time the Senate denies this bill, we will do our best to not talk about it. We are recording some ahead of time, so by the time you're listening, it might have already passed. It might be denied. They might be working on some provisions. But as we have it now, as it passed through the House, we're going to be dissecting it and talking about some of the main points of contention, main points that you, the taxpayer, should be aware of, main points that you, the business owner, the entrepreneur, the real estate investor, should be aware of. If you get any sort of value out of this, please do us a favor and leave us a 5-star rating and review. I'm happy to announce that we are back on YouTube after a couple weeks of not being there. We ran into some technical difficulties, and by the grace of God and the talents of our team, we are now able to be promoting ourselves and these topics out on YouTube again. So go ahead and subscribe us on YouTube, subscribe to us on Spotify, subscribe to us on Apple Podcasts. It really helps us build the audience, get in front of more eyes and ears like your own. And with that, we can jump into it. So today we're going to be talking about one of the key parts of the big, beautiful bill that made its way through the House and is now with the Senate. Now, before we get into that, let me just make clear that there is no guarantee that this bill passes. I was listening to Senator Ron Johnson recently, who is a senator out in Wisconsin, which is our neighboring state. Better Books is currently located in Minnesota, working with clients around the country. But Ron Johnson's over in Wisconsin, spends a lot of time in DC, and he was on a podcast talking about why he is not in favor of what this bill has in store. Mind you, this is a conservative senator. He's a Republican out of Wisconsin. So most people believe that conservatives all around the country are just getting behind Trump and bowing down to Trump and doing whatever Trump said. But that's just not the case. Ron Johnson has some serious concerns about this big, beautiful bill. And the big concern that he was talking about was the fact that it does nothing to address the budget deficit that we're currently dealing with. The United States is in a monumental amount of debt. We have, I think last I heard, it was $37 trillion worth of debt. We spend more than we make on a regular basis at this point. That has not always been the case. So for those that are new to following the state of our nation, the state of the union, if you will, our economy, our financial standing, our political standing, our social standing, the fact that we are $37 trillion in debt is not something that we have dealt with in the past, right? We have a rich history. We have a lot of courage that our ancestors have developed and worked out in their own lives to get us to this point. But we have never been at this level of debt that we currently see in our economy. And that is why somebody like Ron Johnson and some of the other Republicans that he is surrounding himself with and voicing his concerns with are speaking out about this, because they don't think that this bill does enough to address some of the spending concerns that they have. With that in mind, however, we will take away we will dive into some of the tax verbiage, the tax insights, the tax changes that would come as a result of this bill being passed. A lot of those tax changes result in lower taxes to you, the American taxpayer. we will address some of them. We're not going to get to all of them in the course of the next month, but we will address some of them here. And we're starting with the one that was a big selling point in Trump's campaign and ultimately his election, and that is the no tax on tips. So this deals with any of those wage earners that currently find themselves working a job. They're working over the 40 hours a week. That is consistent with the full-time pay. And as a result, they have in their contracts or in their employment agreements that they earn overtime when they work more than 40 hours. So when they work more than the time allotted to a regular work week, they get paid overtime. As current law stands, they pay taxes on that overtime. So this includes the steel workers. This includes a lot of people in the trades industry that work for a business. They get paid overtime because their contracts say, and ultimately the law says, that they can't work more than 40 hours without receiving a benefit on top of those 40 hours. I believe it's all put into words through the Fair Labor Standards Act of 1933. So this is going back. The United States was coming out of the Great Depression, maybe in the middle of the Great Depression, and probably FDR was in charge at that time, and he and his other political leaders put into act the Fair Labor Standards Act, which basically said that employees have to get paid overtime, so time and a half typically, when they are working more than the allotted 40 hours that you would consider a fair work week. Trump, in his coming into his second term, got a lot of news headlines. A lot of the media outlets were talking about this promise he was making, and a lot of people in the areas that might be considered the swing areas of the nation. So a lot of those blue collar towns in Pennsylvania, in Michigan. I mean, Georgia is a swing state as well, but a lot of these, the trade workers who typically are working a set number of hours and then get paid time and a half overtime on top of that, he was able to win a lot of approval from them by saying, I think you should not have to pay taxes on overtime. And in this law, they are, or what could become law, they are proposing that there would be no taxes on overtime. So what does that mean? What are the requirements for this? What is the legal jargon that's being used to actually potentially see this become a law? I am so glad you asked. So the first thing is that it would be an above the line deduction. So it actually, let's just start off by saying that the law does in fact say that there would be no taxes on overtime. I will read the law word for word. All right. So it says section 110102, no tax on overtime. Current law is not applicable, meaning there's no law in place for this type of ruling. Now the provision, so what they are recommending and what will become current law if it makes its way through the Senate, as it has already made its way through the House, it says this provision creates an above the line deduction. So remember that, above the line deduction for overtime premium pay during a given taxable year. So overtime premium pay, likely meaning that there is a premium on top of it. That's the time and a half that I just mentioned. Qualified overtime compensation means overtime compensation paid to an individual required under Section 7 of the Fair Labor Standards Act of 1938. So I was wrong in my date just a few moments ago. I said 1933. It's 1938. That is in excess of the regular rate as used in such section at which such individual is employed. So again, that's the time and a half. There is an excess amount to the regular rate. Additionally, taxpayers who are highly compensated employees or with earned income exceeding the dollar amount in effect under IRC Section 414 Q1BI are ineligible to receive the deduction. A work-eligible Social Security number is required in order to claim the deduction. The deduction is allowed from tax years 2025 through 2028. So obviously there is a lot to consider there, right? We can start by saying, okay, they said it's an above-the-line deduction. What are above the line deductions? An above the line deduction is simply an adjustment to your income amount. So things like an IRA contribution is an above the line deduction. Below the line deductions are what most people refer to or understand them as the itemized deductions. So these are things like your interest on your home, your medical expenses in excess of 7.5% of your adjusted gross income, your charitable contribution. All those are itemized deductions. Those are below the line deductions. Above the line deductions are a direct decrease to your income prior to the standard or itemized deduction. So basically it means that before considering whether you're going to take the standard deduction or the itemized deduction, you're going to get this deduction if you qualify. So that's one thing to point out. This is a deduction. So again, for those that this might be relevant to, those people who are working overtime and under the $160,000 threshold, which I haven't referred to yet, but I will. This is a deduction. You have to make sure that if this becomes law, you are getting this deduction, right? Just because you qualify does not mean you get it. In the same way that just because you contributed $7,500 to an IRA does not mean that that has been communicated to the IRS in the form of your tax return. You need to make sure that you get this deduction. And this is why Americans overpay taxes on taxes on taxes year after year after year. Might be aware of information, but we might not be providing the right documents, providing the right information, communicating with our accountant who might not be communicating with us. And as a result, we might qualify for a deduction, but it might not come as a result of the taxes being prepared. And so that's something to be aware of, that if you do qualify for this deduction, be sure to make sure your accountant is aware of that you actually qualify, that you made overtime, that you paid taxes on overtime, and you don't think that that should be a part of your taxable income. Or you might not have paid taxes on overtime, but it's going to decrease the total amount of your income. So if you made $150,000 and $50,000 was attributable to the overtime pay that you received, then that is a deduction from that $150,000 and you get taxed on the $100,000 minus whatever deductions you get below the line. So something to keep in mind. The left hand needs to know what the right hand is doing. Just because you're making overtime and you qualify for this deduction does not mean that your accountant knows that you're making overtime and that you qualify for the deduction and you made $50,000 worth of it, and your income, your taxable income should be $50,000 less. So there's one thing that you need to be aware of, one thing that you need to act on. Again, if this law passes as it currently is. Okay, we covered above the line deduction for overtime premium pay during a given taxable year. It's in line with the Fair Labor Standard Act of 1938. If you're getting time and a half for overtime or you work for an employer, chances are that qualifies, right? This is something that, in my understanding, the law basically states that if you're requiring employees to stay longer than 40 hours a week, you have to pay them this amount because the law says so. This law passed in 1938. Additionally, taxpayers who are highly compensated employees or with earned income exceeding the dollar amount in effect under IRC Section 414 Q1BI. Who here knows where IRC Section 414 Q1BI is? No one, right? It requires you to go in and see what that says. What this is telling us is that not everybody who makes overtime qualifies. So we have to go into that law and that section of the tax code and determine, do I qualify or do I not? And for your benefit, we have already done so. And that threshold, that amount that would put you over the highly compensated employee amount is $160,000 in 2025. So when this law passes, when this becomes law, if you made more than $160,000 and you are an employee who made overtime, you do not get this benefit. Now, it doesn't clearly state whether that up to that certain amount you would not pay taxes and then over the amount you do pay taxes, but it does say highly compensated employees are ineligible to receive the deduction. So to me, my understanding is that if you make more than that amount, you are not eligible. And so you don't get any of it. This is something to consider. If you are a highly compensated employee or have the potential to be a highly compensated employee, then it might serve you to keep track of how much money you're making on a regular basis, so that if you're coming close to this $160,000 amount, you might take less overtime. You might not be taking any more overtime. Right? Because if it's under $160,000, you get a deduction for all of the overtime that you worked, and over $160,000, you get taxed on everything. Well, don't you think you're going to want to know where you are and what the implications of you taking an extra 5 hours of overtime towards the end of the year is? The answer to that is yes. So before you go running in joy that there's no tax on overtime, and mind you, not every listener here makes overtime pay. A lot of our listeners are real estate investors and business owners and entrepreneurs. Don't worry, I'll cover how this affects you as well. But for those that might just be on here because we're talking about the no tax on overtime and what it means for you, again, assuming this provision becomes a law, and you are in that range of potentially going over $160,000 and potentially being less than $160,000, there's some planning that comes into that, right? That could be depending on how much you make in overtime. If you made $40,000 in overtime and that puts you into the 24% tax bracket, and now you get taxed on $40,000 rather than not being taxed on $40,000, and it's 24%, you're paying $10,000 worth of taxes potentially. That's not something we want, right? So there's planning, and this goes for everyone, whether you're making overtime or not. If you're not planning as it relates to taxes, there's things in this tax code and things in recent tax changes that could massively affect the amounts that you're paying, and you need to be aware of them. So we've covered the threshold, we covered who qualifies, who doesn't qualify, how it is deducted. The last two pieces, a work eligible Social Security number is required in order to claim the deduction. What are they saying there? You have to be an American citizen. You cannot be an illegal immigrant taking money and possibly working for that money and working overtime and expect to get this deduction. And chances are, if you don't have a Social Security number, you're likely not filing taxes. You are required to have a Social Security number to file taxes. But also for those business owners, if you're employing people who might not be legal American citizens and you're paying them as an employee, you're supposed to be withholding payroll taxes. And so if you're assuming because they make less than $160,000, you're not responsible for withholding taxes on their overtime. And regardless of whether they get a paycheck, and again, some of this is obviously you need to have a Social Security number to file taxes, but also to receive a paycheck, because in order to receive a paycheck, you need to have Social Security withholdings. And so some of this is like not applicable, because if you don't have a Social Security number, you're likely not getting paid a paycheck and you're probably being paid under the table, and that is not legal. But if you have somebody that you're paying in that regard and the IRS comes and audits you and you're supposed to be paying them as an employee and they don't have a Social Security number, well, now you're at massive legal liability. You have unpaid taxes and penalties and interest that you are responsible for in the form of payroll taxes. You're taking a deduction that shouldn't be a deduction because you're paying somebody who's not a legal citizen. And so they'll probably add that back to your income. And now you're paying taxes on all of that money that you deducted by paying this person. So it's just a mess. What I encourage you to do is make sure that all of your contractors, all of your employees have Social Security numbers. You are contributing to the welfare of our nation by doing so. You're contributing to the security of your business and your personal finances. You're contributing to the well-being of your other employees, because now those who are legal citizens versus those who aren't, one's paying taxes, one's not. That's not fair. So it is in your best interest as the business owner, as the beneficiary of this American economic system, to always pay through legal means, to pay legal citizens for the work cut out. The deduction is allowed, this is the last part of it, allowed from tax years 2025 through 2028. What does that mean? It's temporary. By the time 2028 rolls around, we're going to be having this discussion again. Should we keep it? Should it go? What was the benefit of the economy, right? I don't necessarily agree with the fact that we put these deadlines on it. Like right now, we're facing a deadline of the tax brackets, and it could be very costly to us, the Americans, if they do not reach an agreement, right? The lower tax brackets that we've been used to for the past 10 years, since 2017, so 8 years really, are expiring. And if they don't do anything, and we'll talk about this in a later episode, if they don't do anything about it, we, the American people, will be paying higher taxes. And so what happens if they don't do anything about it? If current law stays, because this law that we're currently reading about does not pass, because senators like Ron Johnson and a lot of the Democratic senators will not approve of this as it currently is, well, then we go to what is currently in law. And what is currently in law is that things are expiring. The tax brackets are expiring. Bonus depreciation is expiring. QBI deduction is expiring. These are things that have resulted in larger amounts of money in us, the American people, our bank account, our investment accounts, our businesses, and they're expiring. So all this to say that right now, this law, as it is proposed, as it made its way through the House and it now sits at the feet of the senators, it's still only allowed from tax years 2025 through 2028. Whether or not we like that, whether or not we approve of it, that's how it's written. And so for those who are working overtime or even paying overtime, this would be temporary in nature. It would last 4 years, and then if there's no changes, it would expire. All right, so that's just something to be aware of and something to note. I said that I would come back to those who are likely listening, the business owners, the entrepreneurs, the investors who might be paying people overtime. How does this apply to you? What can you do to plan around this? Okay, so again, it's not law, but let's just say it passes through law. And some things we need to consider, like because this is eligible for 2025, we need to be able to say, okay, let's hope that this gets through. And then when it does, how does that change our approach? Well, if you had these conversations or you thought about it before it went through, then it's an easy decision, right? So as a business owner who might be paying somebody overtime, you are withholding taxes from them. The employer portion of taxes is on you to withhold and pay. And so now if they are no longer required to pay taxes on that overtime, again, assuming they're less than $160,000 worth of income, well, then you don't have to pay those taxes. And so because you're doing it the way that you have been, you're probably going to withhold those taxes and you're probably going to pay those taxes because some of these softwares that you use don't really adjust. Now, I'm sure that they will program them and correct them and give you that ability, but also see that it results in massive tax savings, right? If you're paying somebody $10,000, $20,000, $30,000 in overtime and you're withholding taxes on that and you're responsible for taxes on that, I mean, that's going to be a large chunk of money. 10% of that is $3,000, $2,000, $1,000. Right? So if that money's staying in your account, that's great. But you want to make sure that you're working with a tax planner who, one, is aware of these things and studying these things and understanding the implications that it has on their clients, and two, guiding you on making sure that, okay, well, now if we have Bill Smith working overtime and he's worked a lot of overtime and now he's put over that $160,000 threshold and we're not withholding payroll taxes anymore because we're told that there's no tax on overtime, but now he's over the threshold and now he owes taxes on that and you owe taxes on that. Well, guess what? Penalties, interest, potential consequences for not being aware of the state of your business, the state of your employees, right? The Bible says that we need to know the status of our flocks or something along those words. And what that means to us in today's age, most of us aren't farmers, is we need to be aware of those things that we've been entrusted with, whether it's our money, our business, our employees, our family, our spouses, our children. We need to understand the status of them. We need to know where they are and how they're working and how some of the things that we're doing with them or for them or through them are affecting us and the status of our flock, right? It's a symbolic way of saying because they are your employees and because you're paying them overtime and because you might not be required to withhold overtime taxes on overtime, but they might be making enough to put you over the threshold that would require you to withhold those taxes, you need to be aware of it. It's your responsibility. And it helps to have somebody in your corner to do so. And so if you're looking for somebody to partner with in the form of a certified tax planner, a tax strategist, a CPA, somebody who's going to meet with you proactively and understand what's going on in your business and how this current tax law is going to change the way that you approach your finances, well, I'd encourage you to reach out to us. Find out if we're a good fit. You know, we're working with business owners. We're going to start applying some of these things to their business because it's important, because if it results in $2,000, $3,000 for one employee, you save $3,000 a year on one employee and you employ 10 people, that's $30,000, right? That's a big difference. That's your next piece of equipment. That's the next down payment on an investment property. That's the next employee, right? So you want to be working with somebody who can have these conversations with you, who can follow the law, interpret the law, help you make decisions based on the law. And that's what we do here at Better Books. If you enjoyed this, please subscribe, leave us a rating, a review. If there's things that you want to hear about, leave us a comment. Reach out to me, Facebook, LinkedIn, Instagram. You can find me there. And yes, I'd love to hear from you. But until next time, God bless you and keep moving forward.